Hello and welcome to this session. This is Professor Farhat. In this session, we're going to look at the Internal Service Fund. In the prior session, we looked at the Enterprise Fund. We are working under the Proprietary Funds. And remember, those Proprietary Funds are business-like funds. Well, we're going to be looking at the Internal Service Fund. If they're business-like, the first thing we're going to talk about, they use accrual accounting. And hopefully you know what this is. In contrast to the Governmental Fund, where they used modified accrual. And if you don't know what this modified accrual, go back and view the modified accrual. So let's go ahead and get started to explain what is the Internal Service Fund and how does it work. And we will work an example to show you how the Internal Service Funds work. So, Internal Service Funds, when is it created? It's created, it's not required, by the way. GASB does not require the government to have an Internal Service Fund. But what happens is this, as the government becomes larger, or it becomes more complex, what they do, they notice that they have repetitive services, such as, for example, they might need a lot of printing work. Okay? What can they do? They can let the general fund handle the printer work, or they can go to an outside service to handle the printing work. Or they might have a lot of purchase orders, which each department might be buying different things. So what they do, rather than having each department buy different things, what they will have a centralized purchasing department, or centralized printing department, or maybe a motor pool where they maintain all the vehicles for the government. Okay, so they create an Internal Service Fund to do what? It's used for sales of service primarily to other departments within the government. So rather than, for example, the police force, rather than the police force going to a garage to fix their cars, what they would do, the government itself would have its own garage where they can maintain the vehicles. That's basically what the Internal Service Fund is. And typically, what they would do is, it's on a cost reimbursement basis, but it doesn't have to. They could also cost plus maybe a percentage, but for sure they need to recover their cost. So this is how it works. So the purpose is to pool resources for more efficient operations. So as we do this repetitively, what's going to happen, we might be able to do this at a cheaper cost than going to the outside. So that's how it really works. That's the whole purpose, is to become more efficient. Often it's more efficient to have a single department responsible for these type of services and charge their cost back to the other department. So what they're saying, it's much more efficient to have one department. And an example could be, as I said, motor pool, where you maintain the vehicles, telecommunications, all the communication services, maybe IT support. So you'll have a department, Internal Service Fund, where you have an IT support that service all the other governmental units. Maintenance, purchasing, supplies, central store, insurance risk management. I might do another recording about insurance risk management. How does the Internal Service Fund work? But it's because it's a little bit unique, but we'll see how. Okay, so let's take a look at this example. Assume that the administrator of the village of Riverside obtained approval. So usually you need an approval from the village council in early 2017 to centralize purchasing, storing, and issuing of maintenance, office, and cleaning supplies in an Internal Service Fund. So what they wanted to do, they wanted to have the purchasing, storing, and issuing of maintenance, office, and cleaning supplies in one fund. Okay? And they're going to call this the Supplies Fund. So they decided to create an Internal Service Fund. Remember, in the Internal Service Fund, we use accrual accounting. And we're going to see what accrual is. It means we have all the assets, all the liabilities on the books. It's an income approach, an income measurement approach. So, to establish a fund, you need financing. Where's the financing going to come from? A payment of $596,000 cash is made from the general fund that's not to be repaid by the supplies fund. So, what happened is the general fund, let's call them the generous general fund, gave us how much? $596,000, of which $290,000 to finance capital acquisition. So when they want us to do of this amount to buy assets, and $306,000 to finance non-capital acquisition. What's non-capital acquisition? Basically finance the operating of the business. We're going to be operating this business, so we need to run the operation. Additionally, in addition to that, a long-term advance of $200,000 is made from the water utility fund for the purpose of acquiring capital asset. Another enterprise fund which is the water utility, also advanced us $200,000. Not bad, not bad. The advance is to be repaid in 20 equal installment payments. So we need to pay back the loan for the water utility with no interest. So all what they want us to do is to pay the principal. So if we'll take 200,000 divided by 20, we have to pay them back $10,000. And we're going to have to make this installment 20 times. The receipt of the transfer and the liability of the water utility will be recorded in supplies fund in the following manner. So basically we received cash. How much cash did we receive? Obviously we received 596 plus 200,000. So we received cash in total 700 cash in total. Oh, well, okay, that's fine. So we received cash in total 796,000. This is transfer in from general fund. This is transferred in from the general fund. And this is, so the 596 transfer in, and this is advance from the utility. Okay, so notice this transfer in, we don't have to repay it. We don't have to repay it to the general fund. Now, obviously, the general fund, on the other hand, the general fund will have credit cash and transfer out. We're not doing accounting for the general fund, but the general fund, once again, they will debit, transfer out, and they will credit cash. Okay. Now, this is basically, we established the fund. This is actually what happened. We just established the fund. Now, what's going to happen is this. To provide some revenue on funds not needed currently, 50,000 is invested in marketable securities. So what they take, they took some of that cash and they invested it in an investment. So we're going to credit cash, 50,000. And we're going to debit an investment account. Okay, so we're going to debit cash and credit, debit investment and credit cash. Debit investment and credit cash. Okay, so this is what we did with some of the money. Okay, let's move on to the next transaction. Assume that in early 2017, a satisfactory warehouse building is purchased. So we purchase a warehouse for $350,000. 80,000 of the purchase is considered to be a land. So remember, if we purchase the whole thing for $350,000, we have to subtract 80 for the land. So the warehouse itself, the building, is only $270,000. So we're gonna debit land. This is the land, and this is the building. We're gonna debit land. We're gonna debit building. Necessary warehouse machinery and equipment are purchased for $100,000, so we purchase additional machinery and equipment. Delivery equipment, the purchase of $40,000, because remember, when they gave us the money, they said you need to buy capital asset, and those are the capital asset. Remember, they mentioned we have to buy the capital asset. Okay, and if the purchase are made for cash, the acquisition for the asset would be recorded in the books of the supplies fund. So notice, we do have long-term assets in the internal service fund. Why? Because they use accrual accounting. So this, we debit land, debit building, debit machinery, debit equipment, credit cash. Pretty straightforward. Hopefully this is no surprise to you. And what are we going to do with these assets? We are going to actually also depreciate them. Depreciate them. Why? Because we're using accrual accounting. You need to depreciate them if you're using accrual accounting, which we'll see later on. Supplies are ordered to maintain inventory at level sufficient to meet expected usage. Now we need to record an encumbrance. No, we not. No, we are not need. We don't need an encumbrance. Remember, this is the internal service fund. We're using accrual accounting. So even though supplies are ordered, we don't do anything. Because in modified accrual, we have to record an encumbrance. So no entry is needed because the proprietary funds are not required to record encumbrances. Okay, this is accrual accounting, proprietary fund. During the year, supplies are received and related invoices are approved for payment in the amount of $523,500. Now we receive and the invoice are approved. Now we have inventories. The entry would we do what? We're going to debit inventory and credit payable. So we're going to debit inventory of supplies and we're going to credit payable. And for this example, we're going to be assuming that we're using the perpetual inventory system. It means when we buy more supplies, we're going to add to inventory. When we use up the supplies, we're going to reduce inventory. Okay. Now, the supplies fund account for its inventory on the perpetual inventory basis because the information is needed for proper performance of its primary function. So I just mentioned that we're going to be using perpetual. When supplies are issued, the inventory account must be credited, of course, because we're updating the account for the cost of the supplies. However, the amount charged the fund purchasing the supplies include a markup with the result that the receivable and revenue reflect the selling price. So basically what's going to happen when we issue the inventory, we're going to recover our cost plus a markup. We're going to make some profit. The markup above cost should be determined on the basis of the budgeted expenses and other items to be financed from net income. So basically, how much should the markup be? Depending on the need of our budget. Okay, if the budget for the village of Riverside indicate that the markup of 30% on cost is needed, issue to the general fund department supplies of $290,000. So now what's going to happen? The general fund needs supplies. So the general funds needs $290,000 worth of supplies. First, we have to remove the supplies. Therefore, we're going to credit inventory of supplies, $290,000, and we're going to debit some operating expense because now the supplies turn into an expense. Okay, $290,000. This is to remove the supplies and record the expense. Now remember, when we provide the service to the general fund, we're going to charge them. We're going to charge them more than $290,000. We're going to charge them $290,000 plus 30%. So we're going to take $290,000 times 1.3, and that's going to equal to $377,000. So what's going to happen? We're going to debit a receivable due from the general fund, $377,000. Now we're going to credit operating revenue, or what we can credit rather than operating revenue, we can credit billing to other departments, which is a revenue account to other departments. So in some textbook, you might say the billing, or you could just basically, rather than the billing to other department, you could credit operating revenues, just basically a revenue account. So this is what you do when you actually provide the service to another department. And here we are selling them, basically we are selling them supplies. So we reduce the supplies balance, we increase the expense, then we debit a receivable, and we credit a revenue. Once again, in some textbook, you might see billing to other departments, which is also acceptable. That's what we're doing. We're billing other department, but this will be the revenue account. During the year, purchasing expenses totaled $19,000, warehousing expenses totaling $12,000, delivery expense totaled $13,000, and administrative $11,000. Basically, we have expenses. What do? We're going to debit expenses and credit liability. The government has chosen to separate operating expenses into three categories: cost of sales and services, administration, and depreciation. Here what we have is we have cost of sale, okay? And let's look at the breakdown. So we're going to have operating expenses, cost of sales, $44,000. So this is going to be separate. The administrative will be separate. Debit administrative expenses and add the 19, the 12, and the 13 to come up to $44,000, and credit accounts payable. Okay? This is to record our expenses. If collection from the general fund during the year total $322, what would we do? Well, what happened is now the general fund, remember we have a receivable from them, due from the general fund, $377, and now they paid us how much? They paid us $322. We're going to debit cash and credit due from the general fund. We're going to debit cash, due and reduce. So cash will go up, due from the general fund will go down. Let's see next. Assume that payment of voucher during the year total $567,500. So we paid some vouchers. Remember, we bought assets on account. We bought $523,000 on account. Do we have any other payable? And we have other payables of how much? Of $55. Okay, so we paid down $567. We're going to debit the payable and credit cash. We're going to debit the payable and credit cash. Okay. The advance from the water utility to be paid 20 equal payment. Remember, the water utility gave us $200,000 and they said pay us back the amount and 10 equal payment, no interest. Therefore, now we're ready to pay them $20,000. So we're going to credit cash and debit advance from water utility. This was from the first entry. The first entry we had this account. So we paid them $10,000. Depreciation. Remember, we have to depreciate the assets that we purchased. If you recall here, and I mentioned this as I was buying the asset, I told you that in the internal service fund, because it's a proprietary fund, the asset that we purchased are subject to depreciation. See, we're going to depreciate them. Now we're going to depreciate them. That's basically what we're doing. And we're going to see what method we are using, and we're going to compute the depreciation accordingly. So let's take a look. Simply put, the reason I'm going over this, I'm sure you know how depreciation works, but I want to make sure to remind you that this is accrual accounting. In accrual accounting, we work depreciation. So the warehouse has an estimated useful life of 20 years, the machinery and the equipment 10 years, and the delivery equipment 10 years. Further, none of the assets have any expected salvage value, no salvage value. So under this assumption, if we're using the straight line, the building will have 13,500 depreciation, the machinery and equipment 10, and the delivery equipment 4. Basically 1/20 and 2/10 years. So we're gonna debit depreciation expense, which is operating expenses dash depreciation. We're going to credit accumulated depreciation for building, accumulated depreciation for the warehouse equipment, and accumulated depreciation for the delivery equipment. Again, why am I doing this? To remind you that the internal service fund hold long-term asset and depreciate long-term asset. Interest income is earned and received in cash on the investment purchase at the beginning of the year, and I don't know how much that is. If it's received in cash, we're going to debit cash, credit interest revenue or investment revenue. Okay, so let's see how much it is. 3,000. So we're going to debit cash. Cash will go up and interest revenue will go up. Assume all revenues and expenses are transferred and transfers has been properly recorded by entries illustrated. The nominal account should be closed at December 31st. Of course we do. We're going to close all nominal accounts. Nominal accounts are the temporary accounts. What are the temporary accounts? All the revenues, all the expenses, and the transfers. So let's list them. We have operating revenues. Let's go next. We have, operating revenues, 377,000. This is what we charge the general fund. We have revenues in here, the 3,000 from the interest. We have the transfer in from the first entry. So we're going to debit all the revenues, credit all the expenses, operating expenses for cost of sales, operating expenses for administration, and operating expenses for depreciation. So our net position basically went up by $603,500. So our net position, our equity, went up. Now, I'm not sure, if I need to mention this, but we need to have a statement of net position, which is equivalent to a balance sheet. And I don't have an example because we work one in the enterprise fund. It's very similar to the enterprise fund. And we're going to have a statement of revenues, expenses, and changes in net position. Okay, just like an income statement. And we'll have a cash flow statement, which is, I'm not covering the cash flow statement. But what I want to remind you, under net position, which is assets minus liability equal to net position, just like with the enterprise fund, okay, we're going to have three types of net position. We're going to have net investment in capital asset, restricted and unrestricted. So we're going to have 1, 2, and 3. Now, if you don't know how this works, go back to the prior session and look at the enterprise fund. This is what I explain in details. How this works. But basically, we have investment in capital fund. We have capital asset of 490,000. This is what we bought, minus accumulated depreciation. So minus less accumulated depreciation, less advance from the enterprise fund. Remember, they lend us the money specifically to buy the asset. Okay, and why 190? Why not 200? Because we already paid down $10,000. So what's left is 190 from the advance. So if we'll take the asset minus accumulated depreciation minus the advance from the enterprise, the basically net investment in capital asset is 272,500. Now in the prior session, I did not really mention why do we have to do this, why do we have to separate our net position, is because the citizens, they need to know how much of net position do we have, but they might be under the impression that if we have 603,500 of net position, they think that we have all this net position available. It may not be available. For example, of this amount, of the 603,500, 272 is basically invested in capital assets, so we cannot really spend it. That's what we're trying to say. And sometimes we don't have any restricted asset for this example. In the prior session, when we did the enterprise, notice we had a restricted asset of cash. So if you have any restricted asset, we don't have any. It's the asset minus any related liabilities. And now we have here 331,000 in unrestricted net equity. So this is how we came up with 603,500, which is matching the 603,100. Why? Because remember, this is the first year. The beginning was 0 plus 603,500 equal to 603,500 because the beginning balance is 0. So this is basically how the enterprise fund work. Remember, not the enterprise, the internal service fund, which is part of the proprietary fund, very similar to the enterprise fund. Why? Because it uses accrual accounting and it uses the same financial statement and the same net position. So if you're not sure what do I mean by the same financial statement, the same net position, go back and view the other fund. If you have any questions, any comments, by all means email me or see me in class. Good luck. Study hard.